All right, in this video, I'm going to go over the first of my list of 6 checklist items that I look for in any stock that I'm going to invest in. And that first item is the relationship between operating cash flow and capital expenditures, or OCF to Capex. That's how I look at it. I'm going to give an example using the company Applied Materials. And I'm going to just go over some of the nuances of why you want to look at this number, this ratio, and what it can tell you, and why the cash flow statement actually can be more important than the income statement when you look at the actual profitability of an enterprise. A lot of sort of unsophisticated investors, they tend to over-focus on the income statement and accounting profits, and you need to cross-check it with cash flow. In fact, some of the biggest accounting frauds, actually, you could kind of sniff them out because you could see, okay, very big cash flows, very big accounting profits, but there weren't cash flows on the cash flow statement that matched up with those accounting profits. And WorldCom and Enron were actually both good examples of sort of financial frauds that you could uncover by looking at the cash flow statement. So the example I'm going to give, and this is just going to be very low tech because it just so happens that the Applied Materials annual report came the other day in the mail. And if you go to page 68, so in the back usually they have the financial statements, and here's the consolidated statement of cash flows. And what I've done here is just marked the 2 line items that I focus on the most, okay? So we have the operating cash flows, or cash flow from operations, and then right below that actually you have capital expenditures. And if you can see here, and you can find this exact statement online, go to seekingalpha.com and punch in Applied Materials, AMAT is the ticker, and then pull up the financials and look at the cash flow statement. You can find the same information, okay? So if you look at, say, the most recent fiscal year, 2020, they produced $3,804,000,000 in cash flow from operations. Capex was $422 million. So the cash flow from operations was 9 times the Capex. And what does that mean? Well, Capex is basically the money you have to invest to keep your plants running, to keep your business going, and to fund any kind of expansion of capacity. And this is a very sort of, I would say it's a wonderful business. Buffett would look at this and say, what a great business. And Applied Materials is a very good business, at least when the semiconductor industry is doing well. And so here's another nuance. You actually need to look at more than just 3 years, right? Sometimes a 3-year period can just capture an upcycle or when times are good. So you want to go back and look at prior annual reports or go back in history, and you want to try and see this company through multiple cycles. And you want to see what this relationship is between these numbers. Sometimes you have a company that's very asset intensive, and they might have an investment period where they build a new plant or a number of new plants. And so the Capex explodes upwards, and then there's periods when the cash flow from operations aren't that good, maybe during a period when there's high investment or a period when there's excess capacity in an industry or during a down cycle. And so you want to look at over multiple cycles what the relationship is between these numbers. Now, with Applied Materials, they actually have positive cash flow that's significantly more than Capex, even when times aren't that good. And that's a nuance, that's a good thing. And it means it's a good business across a cycle. Some industries may not be very good businesses during down cycles, and sometimes there's loss of cash flow. In other words, the cash flow from operations is negative, and so you have to look at it over the course of a full cycle and see what the relationship is aggregated over many years. But some companies are simply just really good businesses, and almost every single year they're producing cash flows that are multiples of the actual Capex requirements of a company. So this is an example with Applied Materials, and it's a very, very good business. Warren Buffett would call it a wonderful business, like I said. So keep in mind that there are these nuances, and then there's another point where I've also mentioned the phrase asset light versus asset intensive businesses. Remember, not every business is the same, right? And some companies are just structurally asset light. If you think about, say, like a financial company, like a T. Rowe Price, for example, what's their asset really would be, say, databases, some backup servers, maybe some office equipment. It's not going to be a very asset-intensive business because their business is buying and selling stocks on behalf of mutual fund shareholders, and there's not like factories or plants to do this, right? Whereas, say, a utility company, in contrast, would be very asset intensive, and it wouldn't have, in general, most utilities, their capex, their operations, cash flow from operations, and their capex are about equal, actually. And then if you also look at, say, REITs, real estate investment trusts, an office REIT or, an apartment REIT, often that is an asset-intensive business, and their cash flows from operations are maybe a little more than capex, but not a lot more. Certainly not the kind of 8 or 9 times multiple that you see with applied materials. So you got to remember that different businesses, different industries have different sort of structures and different cash flow characteristics because of their asset intensiveness. And this doesn't mean that an asset-intensive business is a bad business. It just means that you're going to have less cash flow over the lifespan of the business to sort of solve problems, to pay dividends, to buy back stock, but just because you have a lot of cash flow, though, that doesn't mean that the company won't do stupid things with that cash flow, right? You can have a lot of companies that use that cash flow to make stupid acquisitions, like Microsoft did over much of its life cycle. They just the cash would burn a hole in their pockets and they would make dumb acquisitions. So there's puts and takes, but in general, all else equal, you want to have more cash flow relative to capex instead of less. And that will tilt you towards asset-light companies as opposed to asset-intensive companies. And so you want to take note of that too. You can't just use this as like your sole like checklist item for looking for a good business. It has to be one of many items, because if you just use this, it's going to tilt your whole portfolio to only asset-light companies, and that's not necessarily diversified. Because, for example, I own utilities, I own REITs. I try to look for them having better cash flows than other companies in their industry. But if you just look for a company that has, operating cash flow that's 9 times capex, you're going to find yourself investing solely in certain kinds of companies. That can affect your diversification, okay? So these are some major points to think about with operating cash flow compared to capex. The numbers are very, very easy to look at. You can find them online, no problem. And these are just some things to think about what it tells you about the nature of the company and its ability to generate cash, okay? And like I said, that's checklist item number 1 in my 6-item checklist for whether I look at a stock and decide to buy it or not, okay? So I hope these videos are helpful, and thanks as always for watching.